Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for August 27th of 2023. I want to start this week with a chart that I just love talking about, and this is presented a little bit different way by Wisdom Tree. And it's this whole notion of how much do dividends contribute to total return of the stock market, and you can see here it is actually very appreciable. And in this case, it's broken out by decade, which I find very interesting because not every decade is kind of constructed the same way in terms of total return. You can see in the blue bar that represents the total return by decade, and this data series goes back to 1960. So, and you scroll across and you can see, obviously different decades we had different returns in the market. But if you go to the far left, and the way to read this is the full period for the S&P 500. You see dividends contributed 29% of the total return. You can see how that's varied over time, 1980s, 1990s. The total return in the market was pretty stout. Dividends had a little bit less influence on that, but you get to the 2010s and 2020s, again, 16 to 19% influence, so maybe not as much, but over time, dividends have contributed about 29% of total returns in the market. And here's a complement to that last slide, also from Wisdom Tree, and it shows you the secular change in average dividend yields for the S&P 500 over time. Back in, maybe call it the 50s, 60s, 70s, and even the early 80s, we had higher overall interest rates. Before 1982, we had that secular decline in interest rates. We had overall yields from dividends that were much higher than they are today. You can see over in the far right-hand side of this chart, this is through March of this year. We're currently sitting about 1.7% on our dividend yield. And so, if you look over, that earlier time frame, average yields were closer to 4. And then beyond that, when we, exited the 80s and got into the 90s, that average yield dropped fairly precipitously. And so you can see over time, again, perhaps less of an influence overall on total returns from dividends, but dividends do matter. And when you think about times like last year, when the overall index is really, fighting a lot of headwinds, perception, sentiment, fund flows, you name it, dividend yield strategies and dividend growth strategies tend to hold up extremely well. Here we have some more stock-related feedback for you. On the left-hand side, we have the concentration of what we're calling the Magnificent Seven. You can see there in the below, it's Apple, Amazon, Microsoft, Meta, which is Facebook, NVIDIA, Google, and Tesla are the Magnificent Seven. And those currently contribute about 28% of the S&P 500. So that particular index is very concentrated. And frankly, we've been kind of shifting a little bit of our benchmark focus over to the Dow Jones, which ironically, doesn't necessarily represent as much of the market, but it represents a broader swath of the market. When you've got almost 30% of the index that's represented by, by 7, very prominent technology stocks that have super high multiples, it really doesn't paint the accurate picture there. But you can see how that has transpired over time. The high here was literally almost 30% back in 22. And then it dipped down, and of course now, not too small a contribution from NVIDIA. That number is way back up to 28. On the right-hand side, we have the National Association of Active Investment Managers index, and the sentiment there has become a little bit more subdued, I'll call it. We had for the balance of this year a lot more optimism on the part of active investors. We see, with interest rates moving a little bit higher, that sentiment has kind of rolled over just a little bit. Here we have 10-year real yields. And so this is from Bloomberg. And so what this is telling us is these real yields have gone higher Again, we've talked a lot about interest rates that have, ever since we had the debt downgrade for U.S. sovereign debt. We've seen a little bit more turbulence in the equity markets, and that has really dovetailed with the higher rates. And what's important in that is that rates have moved higher not because of inflation, but because of anticipated growth. So these real yields are moving higher, and so that's corresponded with a weaker equity market at this point in time. Here we have some other data. We're digging into a little bit of economics here, and then we'll get into stocks and maybe a little fixed income here for a second. But wanted to look at household expenditures as a share of GDP. And so I talk about this a lot, so this is a really interesting slide for me. And you've heard me say that, consumption or household expenditures, tends to run about 2/3 to 70% of the total economy. And you can see that depicted here. So, and that's the highest in the developed world. You can see overall the world share is probably around 55%, European Union closer to 50%. And so, the consumer matters a lot more in the U.S. than it does in other parts. And, we've also talked a lot about how China is not consumption driven, they're export driven. You can see that very well depicted here in the red line. U.S. heavily consumer driven. So when we look at data, we're paying particular attention to such things as retail sales, consumption, consumer sentiment, consumer expectations, those types of things that tend to manifest into real purchases down the road. Here we have the Atlanta Federal Reserve number. And I've shown you this on occasion. And oddly enough, the Atlanta Fed's done a really phenomenal job of kind of pegging GDP numbers on a quarterly basis. And you can see here, I think I showed you a version of this chart about a month ago, and they were calling for something close to 5.5%. Now they're calling for a third quarter GDP number somewhere closer to 6%. And you can see in that blue shaded area, that represents the range of forecasts from consensus economists out there. And you see that the solid blue line in the middle of that represents how that consensus has changed. And so, as we exited June, consensus was moving higher. People were feeling a little bit better about things. Obviously, that was taking place at the Atlanta Fed too, but there's a clear divergence here in expectations for economic growth. And so, if you think about 6% annualized growth, that clearly is at odds with any kind of expectation of having a recession or a major economic downturn on the doorstep. Continuing the economic theme here, we've got business investment and manufacturing structures. We've talked about this a little bit before. This is on the left-hand side. You can see in that dotted line that represents the second quarter level, and I guess the overall number is less important than the direction of it. And you can see a very clear uptrend here in the most recent data on the far right side of that left-hand chart. Some of this has to do with the CHIPS Act, semiconductor manufacturing, but it's not just limited to that. And so, this is absolutely a positive takeaway when you look at investment in manufacturing structures, when you consider that manufacturing's been in a likely recession for a period of time. This is definitely a good thing to have kind of manifest before our eyes. And if you look over at the right-hand side, you've got business investment, and looking into the manufacturing sector really spiking right now. So if you just don't pay attention to anything else and look at this corner of the economy, you have to be feeling relatively good at the moment. Here we have the Kansas City manufacturing data, continuing on the manufacturing theme. Granted that services matter more to the overall economy than manufacturing does, but manufacturing is still very important and still drives a pretty high correlation to overall economic growth. And so Kansas City Fed data is important. Obviously, we had this release that coincided with their symposium in Jackson Hole last weekend. You can see, at least in the Kansas City region, Fed region, that you've got production moving higher. You've got the manufacturing index overall kind of stabilizing after a period of, kind of sustained weakness through the balance of this year. So again, this is pretty positive data. On the right-hand side, we've got capital goods orders. So this is a national number, not just a Kansas City Fed. You can see in the black line, this is kind of the all-in number. So it's still positive. It's certainly well above pre-pandemic levels. I'd say moving higher, but not in as much a decidedly so manner as was the case a year or two ago. But it's still moving higher. But if you deflate that by private capital purchasing inflation or PPI, then that number doesn't look as good. So here's, one side is like on the left-hand side, it's positive feedback, positive data points. On the right-hand side, you get less excited about it. And so it's just, we sit here at this juncture with a confluence of some data that's really positive, some data that's not so positive, some data that doesn't really look that good. And, we're just kind of caught betwixt in between right now. Here we have inflation and expectations, Fed funds rate there in the solid blue line that you see. You've got two representations of inflation. One is observed core inflation. That's in the light blue line. You can see that that's coming down. We've talked about that. No surprise there. We're still above 4%, kind of almost 4.8-ish, and we've been observing that data series for a while. And then importantly in this beige line, if you will, is the year ahead inflation expectations. And so, over time, you should expect core inflation and 12-month forward inflation expectations to kind of, coalesce, because, the latter is actually important to some degree to the former in helping to define the former. Like expectations, eventually drive behavior, which drives, realized data. And so in this case, you see both of those data series, both the observed inflation number as well as expectations moving lower. So this is just an update on a trend that we've been observing, and, it's pretty well understood that, rates have been in decline. I thought this was really interesting. It shows the cumulative increase in Fed funds rates from the beginning of the rate tightening cycle. And I have shown you this chart before. We have maybe a couple more months worth of data that extends that black line up there. And you can see, it's at a pretty high altitude relative to these other rate tightening cycles. And it just shows you, the degree to which this tightening cycle has had an impact on a lot of different things, and the least of which is in the banking sector on balance sheets when finance managers were not paying attention to the rapid ascent of rates, and it was causing wreaking havoc on their balance sheets. And then you can see, from a mortgage standpoint, rates moving extremely fast, much faster than prior cycles, and how that's impacted the housing sector, home buying, mortgages, et cetera. And, the most recent one that we have in terms of the rate tightening cycle is back in 2015, which is in that green line. And you can see the stark differences between the two. Back in 2015, it was really kind of a slow, methodical, almost like a pub crawl kind of a migration of rates higher. And obviously the tightening cycle wasn't nearly as robust as it is now, having moved up, 5.25 to 5.5% from its zero bound. So just a reminder of just how dislocative the current rate tightening cycle is as we kind of sit and reflect over the prospect of perhaps one more rate increase before the Fed is done with this particular cycle. I want to turn my attention real briefly to government debt and what are the implications here? Because I think it is going to be a conversation is going to get more contentious and certainly going to get more serious as we go years into the future. And all of these charts here, these three charts paint the same picture. And you look in the upper left-hand side, you've got debt levels as a percent of GDP, and the blue line, or the blue shaded area rather, represents observed data. Of course, the peak in debt as a percent of GDP was back in World War II, and it hit 106%. If you go back a long period of time, 50 years, historic average there is 47%. And obviously, we're well above that and moving higher, and you can see that very clearly defined here in this orange shaded part of this particular chart. And you get up to, and honestly 2053 is what, essentially 30 years from now, and you get up to 180% of GDP, then that puts you in a league with like Japan, Italy, when you get into these secular slower potential growth rates, and also the interest burden and debt service from this, it just naturally crowds out other discretionary spending. And so when you look at net interest expense as a share of total government revenues in the lower left-hand column, you see that spiked up very clearly, and it will continue to move higher. And then over on the far right, it's the estimated annual cost of servicing the debt. And you can see the impact of the issuance and the deficit spending that we've had to date and how that is likely to persist into the future. And again, I want to be clear that our government doesn't have a lot of headroom for discretionary spending. And so when you crowd it out with increased interest burden, it's going to create a very acidic, I'll call it, potential political climate. So over the last few weeks, notably, we've seen the increase in interest rates, as we've talked about already. And we've also seen increased Fed rhetoric. We heard Chairman Powell at Jackson Hole last week kind of give a little bit of a hawkish tone, saying that inflation was still very much on their minds and they're prepared to act to help continue to bring it down, because they do not want a policy mistake kind of on the order of I'd say what happened back in 1937. The Federal Reserve back then, a very young Federal Reserve, got complacent and they figured that they had licked the problem. And so they kind of eased off the accelerator. And we had a resurgence of inflation, and that caused us to hit a double dip recession. So, historians are looking at that and they're saying, Fed's already made one mistake in missing the inflation on the front end. They certainly don't want to make another one, managing it on the back end. So you can see here that the implied terminal rate, which would be, the peak in rates for this particular cycle, is currently sitting about 5.5%. And that has definitely moved up, although it was higher as we kind of headed into March, which was when Silicon Valley Bank blew up. And of course, we've recovered that for the most part since then. Interest rates on a weekly basis. Here we've got, as we begin to transition over into the housing sector, we've got an overlay here of the 10-year Treasury and the 30-year mortgage. You can see the spread between those two has been, I think, for the most part consistent, with the exception of last year, but we've really seen that kind of blow out this year. And so we have some extraordinarily high 30-year mortgage rates, that we haven't seen in many, many, many years. And you can see the delta there between the 10-year, which it is indexed to, but those are moving higher. Obviously, an implication there for the housing sector, for demand. I will say that at some point, 30-year mortgages, people, with regard to 30-year mortgages, that people are going to get, pretty accustomed to higher rates, and you're not going to hear people bellyache over, well, I just could have had a 3%, mortgage, like a year ago. I mean, they're going to be talking about, maybe a 6.25% rate being a real bargain relative to where they are now, and people's memories will fade over time, and I think we'll build a certain level of complacency over rates at these levels. Here's our 10-year Treasury inflation protected yield or TIP yield. This is a measure of real yields. And so, as I was mentioning before, inflation hasn't picked up. And in fact, inflation is migrating the right way. It's just moving fairly slow and methodical, but real yields have picked up. And so, there are a lot of different implications for this. This is typically not a good thing for stocks. And honestly, you've got to go back, to the, global financial crisis almost to see TIPS yields as high as they are now, which honestly is a little bit attractive. Again, providing a lot of, a lot of real yield right now. So when you think about real yields, what is that? That's the nominal rate of a 10-year treasury, minus the inflation. And so that's where you get this number. And obviously those rates are moving higher. This is really good for savers, not so good for borrowers, and is likely to persist or, maintain a persistent higher overall rate for longer. Two-year government bond yields also moving higher. They're above 5%. You can see that, before Silicon Valley blew up, that they were moving in the same direction. And honestly, for the last several months, they've been moving up with relative conviction too, with a couple of brief respites there in this trend line. But this is a fairly deliberate move, and we're to a point now where I think we're seeing a little bit of a different yield curve than what we had before, because those 10-year rates are moving higher, 2-year rates are moving higher. It's beginning to kind of flatten out the yield curve a little bit more. But obviously something that we want to watch because this is important to short-term investment. Economic Surprise Index from Citigroup. There are a lot of different indices that kind of glom together a lot of economic data and kind of package it as this like economic surprise index. And when, the surprises are good, like the reported numbers are better than expected, then that's a positive surprise. And so, honestly, for the last several months, we've seen a lot of positive surprises in the data, and that gets people excited and increases investor optimism and investor sentiment, and retail investors want to go pour money into risk assets like stocks and so on and so forth. It is peeling over a little bit, but I can tell you at a 60 index level, it's still extraordinarily high. So there's still a lot of relative optimism out there, and you could read this two ways, right? You could say, listen, the data is just flat strong, and I do think there is some of that. Surprisingly strong. But then the other side is, are you estimating correctly, right? Are you underestimating given the circumstances in the economy? And there's still a lot of pessimists out there that don't believe. They're kind of like in somewhat of a denial over some of this surprise data. But it is interesting. It's not where we thought we would be at this juncture, but it is what it is. And we have consumer sentiment from the University of Michigan on the left-hand side. We've got the sentiment index. And again, this is influenced to a fair degree by inflation expectations. And so as those inflation expectations have come down, the sentiment index has gone up. You can see that very clearly depicted here. So we're in an uptrend, even though we're off our peak. Consumer expectations are also a little bit higher. Now, they did trough in both categories last year, and they do fall below their long-term trend lines, but they are decidedly not as negative as they were. Now, if you look at personal interest payments as a percent of disposable personal income on the right-hand side, this data coming to us from B of A, Merrill Lynch, Global Research here, you can see that's beginning to spike. And so this consumer-led data, consumers are still optimistic, but you can see on the right-hand side that their spending is being fueled by different mechanisms, and they're paying more for the privilege of doing that. And you can see interest payments are moving higher. This is not a huge move. You can see relative to history, we're still kind of maybe slightly at the long-term trend line, but this data I feel is definitely moving higher, and it's going to become more important to look at interest burden, credit defaults, and or credit stress, I should say, as we head into the last months of the year. Here we have the MBA mortgage purchase index, and as you can imagine, with rates moving higher, we just saw the 30-year fixed mortgage rates really spike well over 7. I mean, we haven't seen these rates in a long time. That you'd naturally expect the mortgage purchase index to be tanking here for the time being. Existing home sales, we saw a downtick in that. 4.07 was the reading for July. We will be eagerly anticipating the August number coming relatively soon, but suspect that is going to continue trend line. Now, there's a different story on the new home sales line. Builders were really optimistic because there's tight inventory, and there's still demand out there. So they're building, they're providing some level of incentives, and say that they're active and they've worked through some of the supply chain issues, although there are some issues out there that builders face in terms of cost escalations and stuff like that they've got to work through. But by and large, new home builders are a lot more jazzed about the current environment than is reflected here in the existing home sale data. Existing home price changes have been positive after many, many months of decline. Again, this compounds and confounds that affordability question that we talked about in the last slide. With rates being higher, prices moving higher, it makes things less affordable. So, people are not as inclined to, want to jump into something right now. They want to feel like, okay, well, let's wait and see if these rates come down. Some people have to, of course, but if you're sitting at a 2.5%, 3%, even a 3.5% mortgage, why would you want, unless you're compelled to by your job or some other reason, to leave that situation just so you can jump into a home that the price is moving higher and you're paying about 7.5% mortgage rate on it. I'm going to switch here to wages and prices, and we talk a lot about wages being sticky along with rents on inflation. And we do know that wages are still higher. We plot on this line here in blue. We've got the Indeed wage tracker, which is just but one measure of wage inflation or wage growth, as it were, and then that's overlaid with core inflation as defined by the CPI, excluding food and energy there, and both moving down the same way, still above pre-pandemic levels, still kind of hovering at like 4 to 5%, which still represents, again, it's above average inflation for wages right now. So even though they've come down quite a bit, and we're happy in some respects for that, wages remaining high is good for consumption, especially if real wages are moving higher. And recently they have been. We've seen real wages, again, nominal wages that are paid through your paycheck, and you subtract out inflation, you get real wages. And those wages have not been growing as fast as inflation for a couple of years. And just recently, real wages are positive, and so that gives purchasing power to the average worker, which is good for consumption. But just note that those numbers are coming down. Here we have the Purchasing Managers Index for various countries, and when you kind of look at the global backdrop and you think about the health of the global economy and trade and whatnot, and obviously manufacturing matters a lot more for other countries other than the U.S. because we have offshored that, even though a lot of companies are looking to onshore or nearshore their manufacturing now because of supply chain issues of years past. You can see by and large that we're still below 50. So this is a diffusion index, which indicates that anything below 50 represents contraction. And so whether it be UK, which is in a bit of a pickle right now. Eurozone, I think, may have troughed out, but we don't know quite yet. And Japan are all in the negative, and U.S. you can see here is kind of bounced around that break-even line here, but we're all basically in contraction right now. Mentioned this earlier, but the credit stress on the average consumer, that's clearly rising. You can see credit card loans that are moving into delinquent, which is defined as more than 30 days delinquent. You can see that on the rise. This number likely to continue to move higher. We know that consumption is being supported in some respects by consumers that are putting more money on their credit cards. But with that, those increased balances moving faster than the ability to pay, you would expect at some point a little bit of stress in this market. And so here's a kind of a first sign of that. And then another credit issue that I see looming, and this is multifamily delinquency rates. So these are basically owners of multifamily, and these basically borrowers in the multifamily space. And so there's a real credit issue here because multifamily in the investment parlay, if you will, is considered commercial investment. So we know there's a lot of stress in office, but there's also a lot of stress in multifamily right now. And so you've got a lot of these loans that are coming due, and you're seeing delinquency rates and so move higher. And so that tells me that a lot of these folks are going to have a little bit of stress in rolling over this debt and refinancing. And so, you just think on the margin, this is not going to blow up the real estate market, but it's going to put a lid on its ability to grow. And I'd say if you're in a kind of a packaged real estate product that has a lot of different exposures, then it really pays to know what those exposure concentrations are. And you just want to avoid something right now that has a lot of office. And obviously by looking here, you want to avoid areas where there's increased stress in the credit markets. Now we're going to transition. We got a couple of charts here on China, remains in the news. And there's a real secular issue in China. There's a lot going on in China right now, kind of like on the near term. They're going to great lengths to ease credit, and we'll see that in a second. I think there's a lot of underutilized construction, very inefficient construction. The economy is just there's a lot of inefficiencies there, period. And we're seeing the structural flaws in some parts of the Chinese economy right now. And, this chart is really not looking at the near term, but it's painting the picture over the next 10 to 20 years, call it. And so you've got newborn birth rates dropping precipitously. That's been in decline for some years now, and will be one thing that will contribute to slower potential growth in China in the coming years. Here we have working age population for China. You can see where it peaked around the beginning, probably I'd say the middle part of the last decade, and it kind of held steady for a few years, and now we can clearly see that that's in decline, and we will go backwards in China, or not we, but China will go backwards in time, and by the time we hit 2050, they'll be back at essentially a 1990s working age population. Factor productivity also in decline. So productivity, when it's high, it keeps a lid on inflation. It also helps you to be more nimble and competitive. When it's low, obviously the reverse is true to some extent. So, there is the risk of heightened inflation in China because you've got productivity, which is kind of an esoteric subject anyway, and how you measure all that. But clearly you want it higher rather than lower. In China, we're seeing a secular shift in that. We have loan rates. This is a prime rate. So these are rates to your best borrowers. 1-year rates, you can see there below 350. 5-year rates below 4.25%, but all of them are coming down. So, there was a point in time everybody in China was very optimistic. The economy was reopening after lockdowns for COVID, and that growth rate sputtered out fairly quickly. And now we see the Chinese People's Bank of China, PBOC, really trying to get aggressive to kind of juice up growth. And our last slide of the day is we sit here and reflect on the number of not only the number of 100-degree days that we've seen here in Central Texas, but the number of like extreme heat days, like over 105. And so those of you who live in Central Texas will look at this and not be surprised one bit, but you can see that black line relative to the trend lines. This is global temperatures. I mean, we're seeing an El Nino that's packing a lot of punch, and we're just well above this trend line right now. And you think about it, it has a lot of implications for obviously water supply, crop yields, health, and all sorts of other agricultural, and just leave it there. I mean, right there, that's enough implications right there. And you've got, the issue of the polar ice caps and rising sea levels and things like that if this persists. And it is pretty amazing to watch. And this comes off the heels, on the heels rather, of 2022 that itself was in the upper boundary of temperatures. So this is something we're going to have to deal with for a while. That's all we've got for this week. Hope you've enjoyed the presentation. Have a great week, and we'll talk to you again soon. Bye-bye.